Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting. Welcome to Charts and Chat for May 21st of 2023. Please share a disclaimer for important information. Started with our chart pack this week. I want to focus on the Federal Reserve. So they have an upcoming meeting here in just a few weeks, as it's indicated at the top of this chart here. And a lot is kind of hanging in the balance. So we got out of the last meeting, the Fed raised about 25 basis points or a quarter of 1%. And the feeling at that time was that the Fed was going to pause. Now, a majority of the Federal Open Market Committee members, those are the ones who vote on these interest rate targets, have said that they feel like a pause is appropriate right now. So there's a lot of data that's pointing down. In the next slide, we have a very interesting analysis from the Atlanta Fed, who has a GDP now forecasting algorithm that has actually been very, very accurate. The interesting thing about this data and about all the data out there is there's a pretty compelling case for slowdown, but there's also pockets of strength that are like extraordinarily strong that are just really kind of confound logic. And as we'll see later on in the chart pack, the estimates for recession have been pushed out a little bit. And I would have thought about 6 months ago that we would already be in that recession, but labor's been very strong. And we've also had strong current income. Wages have remained relatively high. Consumption has remained relatively strong. We know that there are breakdowns in the internals of all of that. But here we look at the market implied probability of what the Fed's going to do in that June 13th, 14th meeting. And as you can see here in the amber line, the probability of a raise has crept up. Now, it was really low for a long time. As you can see here, I define long time as basically about 2 months. But you can see that probability of a pause has gone down at the same time that the probability of raise has gone up. And so again, there's a lot of ambiguity in pieces of the data, and I still think that the Fed is going to pause. I don't think that there's enough consensus to raise, but I just wanted to highlight that as part of this whole compendium of information that everybody is trying to kind of siphon through right now and kind of begin to try to crystallize their thoughts as far as where we're going to be at the end of the year. And now we're looking at what I had foreshadowed in the prior slide. And this is the Atlanta Fed GDP Now, GDP or economic growth estimate for the second quarter. And so we're going to get the first reading of this for the second quarter in about the third week of July. And right now you can see in the green that they're actually forecasting something that's above 2%, whereas the consensus of all of the estimates out there are between -1% and 1%. You can see that the consensus itself is right close to zero. And so if we do have this kind of print, that is serving as an outlier. As I mentioned in the last slide, the Atlanta Fed and this particular calculation has actually been fairly accurate over the last couple of years. And so it does pay to watch and to pay attention to this, see where this ends up. But right now, the consensus estimate for the second quarter economic growth is pretty benign. And here we have a chart from Bloomberg Survey of Economists here. And this is what I was referring to in the first slide as well, and the fact that the estimates for recession have been pushed out a little bit more. And you can see here, where we sit in that far right dotted line, May 2023, that, the forecast is for the third quarter, not the second quarter. And again, the second quarter estimates on a consensus basis are just slightly above zero. Forget what the Atlanta Fed says for the time being, but this is where the consensus is, and this is what this slide is all about. And then we have two negative quarters, third and fourth quarter. And so you can see that recession has been pushed out from where we thought we were going to be back in, say, November. That's been pushed out, essentially about 6 months. Here we'll shift to a couple slides on housing. Median home prices on a 12-month rolling change. We see it's negative 1.7 for the April data that we can see right now. You can see the progression there. So with as strong as a market as we saw in terms of home price appreciation in 2021, we saw a fairly dramatic deceleration last year, and that deceleration actually continues here into the spring of 2023. Here we have a chart of existing home sales, and you can see the progression. The dotted line represents the April 2023 number here, and you can see how that's kind of fared over time. And obviously 2005, we had that deceleration prior to the global financial crisis. Then we had the GFC and then the aftermath of that. And then we had a very prolonged period of positive growth in existing home sales, a lot of mobility, and then we have the pandemic, and you can see that we haven't seen a deceleration overall directionally in existing home sales like this since just before the global financial crisis. And I'm not foreshadowing that that's going to happen because a lot of things are different this time. Accounting is different. And credit default swaps, that whole market is, I'm not making that parallel. I'm just saying that existing home sales have decelerated at a fairly strong rate in many respects due to the rapid rise in interest rates and the whole affordability equation beginning to unwind a little bit. Here we have the yield on 10-year U.S. Treasury. And so you see here that we're trading in a bit of a range around 3.5% right now and have for essentially a few months. So we did see that spike over 4 here in February, beginning of March. You can see the kind of the progression here going back to last September. We have that spike, but we've had a lot of oscillation around that 3.5 level. And this comes at a time where the Fed has continued to raise rates. Obviously, they're at a range on short-term rates of between 5 and 5.25, and we know that short-term treasuries are actually trading higher than that because of the debt ceiling issue that we have in Congress right now. But this is clearly pricing in a strong sense of feeling that these rates are going to be coming down over time. We have a few slides on credit. Here we have bankruptcy filings. You can see here the latest reading is, at least on a year-to-date basis, it's clearly picking up from what we've seen over the last several years. Expect this trend to continue. Again, more signs that the economy on a very broad sense is slowing down. Here we have small business credit perceptions and bankruptcies. And so you can see in the gray line bankruptcy filings. Again, this is from the National Federation of Independent Business, which is really kind of the trade association spokesperson for small business. And of course, bankruptcy data comes from court filings, which, again, we saw in the prior slide that bankruptcies are moving higher. This data is perhaps a little bit lagged, so we're not seeing it yet. But we also see here in the blue line expected credit conditions over the next 3 months, and that is pushed forward a year. And so with that blue line moving up, you can see on the right-hand margin there that that's an inverted axis there. So basically, with that blue line moving higher, it means that credit conditions are deteriorating, and you can see how bankruptcy filings tend to correlate with that. So, clearly with credit conditions tightening, and we've got another slide for that coming up later, that you would expect bankruptcies to continue to push higher. Here we have, though, some interesting data. Retail and food service sales change month over month. You can see that it ticked up last month. So we have, this data on the one hand that is not very conducive. And we'll see leading economic indicators a little bit later in the chart pack, and it's clearly rolled over. But here's a pocket of strength during a kind of a period where we've seen some fairly notable declines in retail and food and service sales here. You can see on the right-hand side kind of the decomposition where the spending is going. We've got online dining out So people are not buying goods. You see electronics, appliances. You see grocery bills coming down a little bit. You see automotives going up, home improvement going up. So again, puts and takes in this whole environment. Not everything is moving directionally, in the same way. And so what we're seeing, or what I can glean from all this, is that the sales, retail sales data is beginning to become a little bit more lackluster, and it becoming harder to predict from one month to the next where it's going to shake out, because we do have these rotations between goods and services. And so, at least for the time being, we can see here that people are still spending on services. Here we have a delinquency chart. You can see, the degree to which certain types of loans are heading into a more categorically serious delinquency, and I would consider that to be, probably like 90 days delinquent as opposed to 30 days. Somebody misses a late payment. That's fairly front end delinquent. That's technically delinquent, but when you get past 90, 120, 180 days delinquent, that's seriously delinquent. And so you see here credit card delinquency picking up. Again, where we were prior to the global financial crisis, still very much below that. Consumer balance sheets, heading into this downturn, were a lot stronger than they were back then. But still, you don't want to see this. Auto loans also moving in the same way. Student loans, not so much, but we do see mortgage delinquencies picking up, but from a very low base. So this is something that is going to be very important to watch in the coming months. When you typically do see these types of trends when you hit slowdowns. Well, and switching here, we've got the Treasury General Account balance. So this goes to the heart of the budget, the debt ceiling negotiations, which have been and continue to be somewhat cantankerous amongst the sides that are still, frankly, posturing. And honestly, I think it may take the market, having a kind of a meaningful short-term hiccup to get these people to the table in a more earnest way. But you can see the Fed's, basically their bank account right here is going down. Speculation is, how much longer do they have before they hit in a default, and how do they prioritize their payments? Now that part is well rehearsed. The Fed understands that very greatly. I still think that there's going to be some type of kicking the can down the road, continuing funding resolution. I think the more nuclear option, if there is, if it is that, is just to invoke the 14th Amendment to say, we will honor all debts, and we will, almost like a force majeure, if you will, to get that done. But clearly the situation is ongoing, and it is, it lends itself to some anxiety in the market. But again, it was very much like this in 2011 as well. And because of that, we see the 1 month Treasury bill spiking higher, so much higher than the Fed funds rate right now. And so, you can get a 3 month Treasury bill for about 5.5%. Again, you've got to roll it, and during this kind of anxious period of negotiations between the Democrats and Republicans on the debt ceiling, I would expect the Treasury bill yield to remain higher. But once this calms down, or we push this out into after the Labor Day recess or what have you, then you would expect that 1 month bill to come back down. Here we have a percentage of small businesses that are expecting to increase headcount. And you can see that this number tracks data all the way from the beginning of 2021, as we're emerging out of the pandemic, but still dealing with Delta and then ultimately Omicron and all of that. But you can see directionally that that's moving lower. So essentially hiring intentions are beginning to falter a little bit. And here's also a share of U.S. Job seekers relocating. And this is actually, with data goes back to 1986, it tells a lot of different kinds of stories about the mobility of labor in our market. People used to, pack up and head across the country for a new job. And it was very common to hear that. And it's common to hear, friends tell us, hey, I took a job someplace halfway across the country, and then they up and leave. And that's happening less and less these days. And people are tending to stay put. Obviously the future of work it lends itself to a more virtual environment, and so people don't feel like they have to move. And so if they are, they're moving to a place where they want to be, and then seeking out the jobs that let them work remotely. But obviously, with affordability being a little challenge right now, we're just seeing, mobility from a housing standpoint, all really bogged down. But this is really interesting to look at this particular data on a trend line basis over many decades. Well, here's unit labor costs, and we know that they have been high. We were looking last week at that downtick and hoping that that trend would continue. We did not see that. So here we have one of these data points that is still stubbornly strong. And we do know that wages, along with rents, are just generally sticky. And this goes to the whole theory that it's going to take a while to get this inflation down. And so you're balancing these arguments of, well, if we need to fight inflation because wages are sticky, then you would be kind of tempted to want to continue to raise interest rates. But at the same time, if you look at leading economic indicators, hiring intentions, all of those things will ultimately manifest in lower wages over time, because there's a transmission. You hire less demand for labor, and it's a supply and demand question. So at some point, with lower demand, that the compensation for that labor that's in lower demand will go down, and so the market will fall back into some equilibrium. But right now, wages are still high, and these are this is a different calculation. Unit labor costs is kind of like an all-in with benefits, but it's still just very sticky right now. Here we have wages and personal consumption expenditure prices. So this is PCE is the Fed's preferred measure of inflation, and you can see there is an inherently tight relationship. And as I've mentioned, wages can be sticky when you're in an inflationary period, and inflation is slowing down, but it's slowing down in a lot of areas other than housing right now. But wages as an input into the service economy, which accounts for a much greater percentage of our overall economic output than does manufacturing. It's very much tied together. You can see that illustrated in this chart from MRB Partners, that we've got the PCE deflator, essentially the Fed's measure of inflation, overlaid with the employment cost index. Again, another proxy for labor costs here, and there's a tight relationship, and those two numbers are very high right now. Here's non-farm output. I mention this because productivity helps to keep inflation low. When productivity is positive, you tend to have lower inflation. However, we have seen negative prints in 3 of the last 5 quarters. It was slightly positive in the 3rd and 4th quarter of last year, but was decidedly negative here, and essentially offset, what we saw from increased hours. And so, what's happening in the later stages of the economic cycle is you've got employers that are trying to squeeze more out of the lemons that they have, I should say. Maybe that's a bad metaphor, but they're trying to get more out of the workers they have because they don't want to commit to hiring more. And at some point, when the demand, the in demand for the service or product slows down, then those hours will go down. But right now, we're getting this negative effect because labor productivity is negative. So it's not helping wages. It's not helping overall CPI right now. And just one more of these things that we tend to watch on a pretty regular basis. Here we have the U.S. dollar, and you can see here, looking at this chart going back to June of 2021, it was in a fairly consistent rise, and this is about as convincing a trend as you'll ever see in the financial markets. And obviously, we saw a peak in the September-October timeframe, and then that reversed fairly dramatically, equally as dramatic, I should say. And then what we've done is we've found kind of a leveling off point, as we've talked about, maybe even parity, which we did, parity with the euro at one point. And we're just kind of oscillating in a range right now. And you can see here that we're essentially kind of testing, these levels right now. And I think the dollar is likely to neither be a source of strength nor a liability, because we've got other central banks that are raising rates, which makes their money more attractive relative to the dollar. So that would put pressure on the dollar. But the U.S. is a safe haven, and if we go into a global profits recession, which I think is very likely, U.S. is always viewed as kind of a safe haven. So that creates kind of puts a bid underneath U.S. dollar. So I think we trade in a range here. Here's a J.P. Morgan Global Manufacturing Purchasing Managers Index. So this is looking across the globe. And again, going to my point about the global profits recession, which I think is certainly on the table. You can see in this line here that we're below the 50 line. And so this is a diffusion index, which means that anything over 50 is expansionary in terms of growth. And anything below that is obviously negative, reflective of negative growth. And right now we're just slightly negative on a very global basis. Now, I do think the picture, we get a year down the road, it's going to look a lot better than it does today. But I think this is kind of the state of being that we're going to have to put up with here for, probably the next 6 to 9 months. Here we have a couple of other indicators I thought were very interesting. Daily Shot does great work on this. Left-hand side, UPS package volume is down. You can see that on a quarterly basis. Pretty interesting. Obviously, the spikes represent the holiday periods and that you'd normally expect shipments to spike. But, in the non-holiday quarters, you can see that deceleration from, the post-pandemic period. And that deceleration continues. Right-hand side, we see Airbnb booking volumes, which ironically, looking at 22 over 21, again, this data doesn't get updated necessarily in real time. So we've got the 2022 data in hand, and you can see how that picked up. And this chart on the right-hand side is reflective of really the core conversation about how spending has shifted from goods. Actually, both these charts represent that. Spending in goods has shifted to spending in services. And so the inflation that we saw in goods in 2021 has given way to the inflation that we're still seeing on the service side. And I think these two charts do a really good job of explaining that. Here we have some regional data that we got last week from the Philly Fed. And, again, you could take any Federal Reserve regional survey, and directionally the data all looks the same, maybe at different magnitudes or whatnot. But the Philly Fed is certainly no exception to the current rule right now. You see the index itself is negative, even though it did witness an uptick, which we always pay attention to, but it's still negative. So directionally, it's that particular survey is still challenged. And again, this is manufacturing, so it's a component of the economy. We look at new orders, and those are still negative. Prices received. So when you look at the inputs into the production chain, those inputs have gone down. Those are negative now. That's actually very positive. So there is a kind of a delayed, and sometimes very pronounced transmission of producer prices into consumer prices. So, if this chart holds and it winds up applying more nationally to all the other Fed districts, then price inputs into the production side for manufactured goods will go down, and at some point the end user that pays for those produced goods will hopefully witness cheaper prices, and this will help to contribute to deceleration in the inflation that we have. Here we have the Conference Board Index of Leading Economic Indicators, and it does a really good job over time of telling the story and foreshadowing recession. And the next chart will illustrate that. But I wanted to show you what we've seen here in the latest series of readings. The last reading here on the left-hand side, you can see it's in red. Again, negative, following in a line of fairly consistently negative readings over the last year. And the right side gives you a breakdown of why it was negative. And you see there in the upper part of that chart, the LEI itself was down 0.65, but the contributors were new orders. Institute for Supply Management new orders were negative. Consumer expectations were negative. Interest rate spread, our inverted yield curve, also contributing to that. And then credit. So I wanted to make note of credit here because we've been talking about how credit availability has gone down, and Silicon Valley et al. Has only accelerated that. So those four components are really weighing on the market right now, and they're all very, very important. Consumer expectations, if they're negative, eventually they're going to transmit into lower consumer activity, which we know the consumer represents 2/3 to 70% of our economy. And if the consumer is decelerating, as would be indicated by this, that does not bode well for economic growth. Here we have the time series for the LEI going back to 1960, and we have that overlaid with these gray bars which represent recession. And if you look at this just on its face, it is pretty telling. It really does a good job over time when you have these dips of kind of overlaying what ultimately gets defined as a recession. Now, looking at the current trend, very consistent with prior downturns. You can see, over the decades here, how those downturns have kind of like mapped almost, right on top of recessions. And so, it's very possible that we're on the eve of something that will ultimately get called for us by the National Bureau of Economic Research at some point. They'll date the recession, but I think this has so much predictive power in it that, with all of the noise that's out there, I think that's just the direction that we're going to head in. And honestly, like I've said before, the sooner that we get into it is going to represent the sooner that we get out of it and we can get to the next economic cycle. Here we have credit standards. No surprise here. They're all really rolling over, and honestly, they have since the beginning of the year. We started seeing them roll over January, February, and then that process again after Silicon Valley Bank failed, and then we had other notable failures. Depositors obviously made good, but lending standards, they probably helped to accelerate that trend on the part of lenders not wanting, obviously an influx of bad loans on their books. Here we have the U.S. 5-year break-even rate. And so this is an estimate as priced into 5-year Treasury rates. Is essentially the 5-year Treasury rate minus the 5-year Treasury inflation protected security, or TIPS bond. And the implied rate of inflation 5 years out is about 2.1. So clearly the market is pricing in its capacity right now a slowing of inflation, and then we'll ultimately get to, but probably not below the Fed's target of 2%. We have two different looks at the S&P 500. On the left-hand side, we've got the all-in index. And on the right-hand side, we've got the equal weighted index. And these are painting two really different pictures. And I think this is pretty important because I've been talking about the lack of breadth that we've seen in the market. And so, as we'll see here very shortly, that the market this year has been led in a very narrow way by large cap technology stocks. And so the broader market really hasn't participated, and that is very much illustrated here. So on the left-hand side, the all-in index going back to June of 21, we're essentially back at those levels now. So, we punched higher. We ended 2021 on a relatively high note. Then we had that terrible year last year, and then we troughed in October. And you can see how the market is kind of hemmed and hawed its way back up to these June 2021 levels. And so, that directionally that the market has moved higher. But again, I want to caution on very, very narrow participation. The right-hand side confirms that. And so this is important from a technical standpoint because we have the moving averages overlaid here. So the blue line represents the 50-day moving average, and you can see that just inherently you have fewer data points, so it tends to move around a little bit more. And then the pink line here represents a 200-day moving average, so you have more data points, so it's not going to move around as much. And technically, it's really not helpful to see the 50-day move below the 200-day, and which it has. So they call that kind of a death cross, if you will. And you can see directionally the market itself. This is, again, the equal weighted S&P 500. So it's taking all 503 constituents and it's creating an equal basket of all of them. And so that basket has not performed as well. So the broader market has not been pulled along with these large cap technology stocks. And you can see that technically speaking, the broader market is not in as great a shape as you'd want it to be. I think looking at the data tells a story here. The stocks that are encompassed in this dotted box here, Apple, Microsoft, Nvidia, Alphabet, and Meta have accounted for 80% of the market return year to date. That's pretty profound. I mean, you've got Microsoft and Apple that just by themselves account for 14%, 15% of the index. The top five account for 25, a quarter of the index here. Very influential. So when you have a market cap weighted index that's heavily dominated by technology firms, I mean, you're going to have these massive swings, and you can see that very prominently displayed on this slide. On the right-hand side, we've got essentially the performance of tech stocks divided by the performance of the broader index, if you will. And you can see here that tech has been very influential for a number of years. It gave up the ghost last year when we had that terrible market, but you can see here in the year-to-date 2023 just how prominent these tech stocks have played. Again, I think this is something that we really need to study and pay attention to. Because the market breadth is fairly low right now. You've got these high-flying tech stocks, these long duration stocks, meaning that they have exceptionally high, generally high growth rates, which bring them high trading multiples. So from a valuation standpoint, they're extremely expensive. And when you have an economic slowdown, it puts you into periods where, that type of growth rate, those growth rates get called into question and become much more harder to achieve, and then these stocks tend to slow down, especially when you get into a recession. So we're going to have to watch this and really pay attention to it over the next few months. We have China's unemployment rate, and the blue line represents kind of the peak early earning years for Chinese citizens. And you can see unemployment rate is moving higher, and this has been going on for a number of years now. So if you talk about China being the engine of growth when other areas of the world, such as the U.S., are slowing down, this type of data kind of calls into some doubt, perhaps, China's ability to kind of sustain that growth rate, over time. What we have for this week. I hope you've enjoyed the chart pack. Have a great week, and we will talk to you again soon. Take care.